Welcome, everybody. We're going to give people just 30 seconds as they join, but we appreciate everyone's time today. Again, thank you for joining. We're going to start in just a few seconds, just letting people in the room, the virtual room. Great. Welcome today. My name is Stephen Rothstein. I'm the Managing Director of the Series Accelerator. Thank you for your time today. I'm very excited about this panel. We're talking about reimagining insurance, a climate-resistant future. There's so much to talk about. Before we jump in, I just want to briefly do a land acknowledgement. While we meet today on a virtual platform, I want to begin by acknowledging that the Indigenous peoples of all lands that we're on today. This is to affirm our commitment and responsibility to improving our own understanding of local Indigenous peoples and their culture. We acknowledge that our office headquarters in Boston is on the traditional lands of the Massachusetts people. So just to give that context. Thank you. Next slide, please. We have what I would definitely call kind of the best and the brightest. And while I could spend the entire hour talking about these other 5 people and their backgrounds, I'm going to be very brief. After me, my colleague Jacqueline, who's the Director of Insurance and has a distinguished background, both working as a regulator and in the insurance area. Appreciate that. Then after her, Mike Kriegler, who is a former Washington Commissioner of Insurance. He just retired after over 2 decades of distinguished service in that role and many others as elected official. And he's been working on sustainability issues for longer on insurance issues than anyone I know. And literally, when people say standing on the shoulders of giants, Mike is one of those people that we're talking about. Speaking of giants, Barney is principal at Greenthread, has a long experience in the reinsurance business and has been served on the Series board, and we appreciate his guidance. And then Peter is the Senior Director of Climate and Insurance Sustainability at Minnesota, and Minnesota is a real leader in many, many ways. And last but absolutely not least, Bridget Carls is Senior Vice President, Public Sector Practice of Guy Carpenter. So again, all of them, any one of them could fill this hour. So we're thrilled that all of them are able to join us now. Next slide, please. Thank you, all of you. Series, many of you on this discussion we work with, but for those of you who don't, Series is a nonprofit advocacy group. We're in our 36th year of service, and we work with some of the most influential investors and companies to address issues that affect our economy. We appreciate, and clearly we've been working in the insurance industry for over 15 years, and love to talk to you more offline. I'll include my link in the chat if there are questions later on. Next slide, please. Within Series, the group that's focusing today is called the Series Accelerator for Sustainable Capital Markets. And our belief is fundamentally that if you look at the financial players, the insurance industry, the investors, the banks, the accountant, that drives so much change, so that this work today is part of the Accelerator's work. And again, appreciate everyone's engagement. Next slide, please. We work with both private sector and the regulators. We're going to focus on today the broader areas of re-engaging and reimagining the insurance industry. And last fall, we produced this 10-point plan that the link is on our website, and we'll share that as well. And my colleague Jacqueline will go over it in more detail. But we think that this is a time for the insurance industry and the regulators and other stakeholders to take a step back and look at other areas. So with that, I'm going to turn this over to Jacqueline for the next portion of this with deep thanks. Jacqueline?
All right. Thank you, Stephen. And thank you to everyone joining us today. So as Stephen said, I'm Jacqueline de Medici Bruno, and I'm the Director of Insurance for Series. So today we'll be using Series' recent report, our 10-point plan for the insurance industry, as kind of a launching point for what we hope will be a really dynamic and engaging discussion. And while our distinguished panelists and perhaps audience members may not agree with every recommendation in our report, we're all here to explore how we can stabilize and advance the insurance industry as climate risks intensify. So to ground ourselves in the current state of the insurance marketplace, 2024 was an unprecedented year, with the same thing being said in 2023 and 2022, as billion-dollar weather events and climate-related disasters in the U.S. continue to increase, with last year seeing 27 separate events. The dramatic increase in frequency and severity of large loss events is leading insurers to reassess their risk models in real time, bringing significant changes in coverage, underwriting, premiums, and availability, and especially in areas that were not historically considered low risk, or I'm sorry, high risk. Next slide, please. So nationally, we've seen premium increases outpacing inflation by nearly 9% between 2018 and 2022, with the top 20% of zip codes in the US experiencing premium increases nearly 15%. And this is all based on data recently released by the joint NAIC FIO data call. Consumers in high-risk areas are paying premiums on average of 82% higher than those in lower risk areas. And that gap in those numbers have only continued to increase and widen, as that data does only go up to 2022. Normally, a typical weather-related insurance event would have resulted in more localized policy adjustments, but today we're seeing entire regions facing transformed insurance landscapes, with some carriers pulling out of markets entirely or just completely restructuring their coverage options. Affordability pressures have greatly increased as carriers absorb these large loss events and struggle to price weather risk accordingly. So these shifts are not just restricted to coastal areas anymore, as we see severe and repeated convective storms in the Midwest, new weather patterns previously unexperienced across the country, recent devastating wildfires in LA, flooding in Kentucky, and historic snow in the South just last month. These changes are what's reshaping the regulatory framework and how insurers evaluate and price risk. Next slide, please. So what these challenges clearly demonstrate are that the traditional insurance framework, it requires a paradigm shift, a reimagining. And this is why Ceres did develop our 10-point plan. We designed this framework to address both immediate market stability concerns, both for insurers and consumers, and long-term industry and community sustainability. So what's become equally clear is that no single stakeholder can solve this alone. And that's why our plan really focuses on that collaborative approach. Each recommendation requires regulators, insurers, and other stakeholders like local governments, community groups, and investors to work together. It's only through this kind of coordinated effort that we can create the systemic changes needed to move the industry forward. So I'll briefly walk you through each point, and you can see how each point kind of builds upon that principle of collaborative action. So the first 5 points focus on transforming how we assess and manage risk. First, we need mandatory climate risk disclosure, because without standardized, comprehensive data, insurers and other stakeholders are essentially navigating in the dark. And we do have the climate risk disclosure survey and TCFD analysis, but currently that does not capture all carriers operating in the United States. Secondly, we must enhance predictive climate modeling and AI integration. The disasters that we saw on the first map show we really cannot rely solely on historical data any longer. We need to incorporate that more forward-looking analysis. Next, innovative insurance products, new solutions such as parametric or microinsurance. These can provide protection in different ways than the traditional models. Fourth, we should incentivize and meaningfully incentivize climate mitigation efforts. This creates that positive feedback loop. Better protected properties mean lower losses and more stable premiums. And fifth, climate-adjusted pricing models that can gradually adapt to increasing risk while maintaining affordability. And what that looks like can take many different forms. Next slide, please. The remaining 5 points address more broader systemic changes. So for number 6, we had a call for the consideration and evaluation of the feasibility of a federal climate risk reinsurance program. which would provide a backstop for extreme events that exceed private market capacity. Next, a call for mandatory climate transition plans, plans which balance both the underwriting and investing sides of the insurance industry. Just last month, some global guidance was released that did incorporate that duality that insurers have into the traditional transition plan framework. Eighth, updated building codes and retrofitting existing stock to reduce future losses and increase resilience. And again, that speaks to that positive feedback loop, lower losses on the front end, equaling more stable premiums on the back end. Next, we must ensure equity and accessibility in insurance markets, and particularly for communities most vulnerable to climate impacts. And again, this can take many different shapes and forms. And finally, leveraging insurers' investment portfolios, which is a combined $8 trillion in assets under management to accelerate climate solutions. So together, these 10 points create that comprehensive framework for action. And while we may not agree on all of the points or all of the specifics, our core goal is shared, ensuring a stable and resilient insurance market that continues to protect communities and businesses in our changing world. So having laid out this framework, I'm delighted to hand things over to our next speaker. As Stephen introduced him, the very esteemed pioneer and leader in the climate risk and insurance space, former Washington Commissioner, Mike Kreidler. Mike, the floor is yours.
Thank you very much. I hasten to point out that my ancestors came from Germany, so it's pronounced Kreidler, but they came over in 1680, so who cares? But thank you very much for the invitation to be a part of this program. This is something as Stephen generously described, I've had a deep involvement with for a very long period of time. As the insurance commissioner, I'd like to think I was one of the leaders, if not the leader of this among insurance regulators over my 20 plus years as an insurance commissioner. But I was also engaged in doing this as a legislator before that, and as a member of Congress even for one term, enjoying the opportunity of getting to know this issue. But in the last 20 years, it's really been a very big step that's been taken by society as a whole and by the insurance industry. We're now getting the insurance industry to do reporting. That reporting is absolutely profoundly important from the standpoint of understanding what one insurance company is doing compared to another. The insurance companies track each other very closely. They want to know what their competitors are doing and how they're doing it. So it's important not only for the general public, it is also very important to the industry itself to understand that they are not going alone if they step out into the climate arena and in various fashions. As I look at the issues, that they are clearly extremely difficult and getting more difficult as we witness now. When I came in as insurance commissioner, was shortly after Hurricane Andrew had devastated Florida, and it really opened the window, so to speak, of my vision of what was going to happen in the future, because when Hurricane Andrew happened, it was very difficult to convince insurers to stay insuring coastal counties in Florida. They had to be told to do it by the legislature, or they wouldn't do business in Florida, the fifth largest by population or something like that in the country. But now we have the state that is number one, California, with its exposure to wildfires in ways that we had never really anticipated. When I was a college kid, I used to fight fires. I was a smoke jumper, actually, when I was 21 years old. By the way, you can understand it. It's not something I'm going to do now, but it was something that really made me very conscious of what fire can do and how devastating it can be. But I don't think any of us ever really grasped the impact of what has become much more part of the vernacular firestorm, which likens back to what happened with the bombing of Dresden and the likes, as to the devastation that can take place to communities. And we saw that in Paradise, California. We've seen it now in Los Angeles, and we're seeing insurers respond to it also, in the sense that they have decided that there's too much risk involved. And that's one where I think Ceres, which has been a national leader in providing information about climate, and doing it in a very agnostic way, from the standpoint of bringing in the principles, whether it's on the green side or the industry side, bringing people together so that they understood the dynamics of the problems we have in front of us. And I'm really excited about the possibility of developing some kind of national catastrophic reinsurance program that can help to back up communities, so insurers do not pull out of markets. Ultimately, it would be desirable if the investments were ones that you could build in the risk that you really understood. The problem we have is we really don't always grasp the magnitude of the risk. California certainly being one of them. We did not really grasp the magnitude of what could happen with wildfire there in the state of California. And that it's a harbinger of what we have to look forward to in the rest of the country. So I look very much forward to working closely with Ceres and with Ceres partners to be able to come up with some solutions and some approaches that are going to enable it, make it possible for us to go forward successfully and make sure there's a viable insurance market which allows economic activity to progress, and at the same time takes into account the fact that climate change is a reality and we need to make adjustments, both in the insurance and regulatory environment and also in the insurance practical environment. With that, thank you very much for being a part of this program, and I'm going to turn it over to Barney.
Thank you, Mike. Thank you, Stephen and Ceres, for hosting this discussion and for inviting me to participate. So I wanted to pick up on the point that Mike made about Hurricane Andrew. So Hurricane Andrew in 1992, and to a lesser extent, the Northridge earthquake in 1994 here in California, in Southern California, really caused three big changes in how the insurance and reinsurance marketplaces worked. And one was a realization, as Mike described, that there had to be a dramatic recalibration of risk. And this is really when the advent of computer modeling sort of took place in the insurance and reinsurance industry and led to more capital being attracted to that industry because they had better measures of risk. They could look at probabilities and look at the future and try to figure out how can you be a better estimator of prospective events, hurricanes, earthquakes, and other events. The second thing that happened is the creation of a new market to augment the capacity in the existing insurance and reinsurance markets. And that's what I have done for the past 30 years, initially actually at Guy Carpenter, and then at Goldman Sachs for the first 10 years of my career as an intermediary, designing products that came to be called catastrophe bonds or insurance-linked securities to try to take insurance risk out into the broader financial markets. And then the last 20 years at an asset manager that was the first and the largest dedicated investor in that space, taking insurance risk at a firm called Nephila. The third thing, though, is that the state of Florida, the state of California, and now almost every coastal state in the US developed government-backed pools for risk. And I think that's a critical inflection point that we are at today, which is we have a choice as a society. Do we want the government pools to be the ultimate repository for risk, which ultimately obviously means taxpayers in each state or taxpayers around the country holding this risk? And make no mistake, that is the road that we are on, whether you're talking about the FAIR Plan here in California or Citizens in Florida or similar entities from Massachusetts and Mississippi and Texas and elsewhere? Or do we want there to be a real market for risk? And so if you look at Series recommendations, and as Stephen mentioned, I was proud to be part of the Series board for over a dozen years. What they've put together rests upon a foundation that assumes you have real risk information. And only when you have real risk information, property by property, municipality by municipality, can you then create a real price. And only with a real price for risk can you then value resilience, mitigation, investments in infrastructure to see how you reduce the risk and therefore how you reduce the price. And unfortunately, in many of the states, going back to the map that Jacqueline showed, price isn't a real price. It is often capped at an unrealistic level. And so if the correct price for a property's coverage against wildfire or hurricane is somewhere between $1 and $100, if you cap that price at a maximum of $10, you're going to undercharge many people, but you're also going to overcharge many people in that your insurance company or your reinsurance company has to overcharge people who live in safe places in order to make up for the gap in undercharging people in very risky places. And that's the world that we live in today. The last component to that, which doesn't exist in the market and would be important in creating a true market for insurance and reinsurance risk, is a term structure, multiple years. If you're going to make investments in resilience, or you're going to make better decisions about where you live, where you build, you can't simply look at a 1-year price. That has historically been fine for the insurance and reinsurance industry because the climate was stable. In a world where the climate is not stable, and some places are becoming more risky and some places are becoming less, the information that you would receive from a risk analysis for 3 years or 5 years or 10 years, and for a price that reflects that risk for 3 years or 5 years or 10 years, would enable all of us to make better decisions. And that is not how the marketplace currently works today. So the recommendations that you see, that the 10 points in Series plan, are important in that they suggest insurance companies, regulators, and other stakeholders can really have a hand in shaping what a true market for risk would look like. But where we are today is not making a lot of progress in that direction. And if we don't do that, that risk ultimately just rebounds back to citizens of the entire country. So look forward to the discussion, and thanks again for having me, and I'll happily pass the mic on to Peter.
Hi, everybody. Thanks again to Stephen and the team at Sirius for having me. I'm really excited to be here, and I'm also excited to be going third because I think many of the things that I would have started off with, Mike and Barney, have already touched on. A little bit about the Commerce Department in Minnesota. This is our mission and strategic priorities. And I'd like to start off with this slide when talking with people, because it helps me contextualize what is for us a pretty unique organizational structure amongst our fellow insurance regulators across the country. Not only are we the state's insurance regulator, and we also oversee state chartered financial institutions, which some of our peer departments also do, but we uniquely also have our state's energy offices housed under our roof. And so that brings a really dynamic and disparate group of thinking to resilience and adaptation issues in particular. And that helps us also bring different perspectives on regulatory oversight and financial activities that we can bring to a conversation that we think not only is unique, but also really helpful to how we approach this. Because as Barney was just talking about, I don't think there's any way that we can make progress in keeping people healthy and safe where they live in the face of what is happening in all of our home jurisdictions across the country if we're not working in partnership with one another. And so I think the Series 10-point plan, you can see that across the board. There's no one row in the 10 items that's just green in one column. There has to be partnerships across all of our work. There was one circle on the slide 6 on that map of 2024 disasters that was on top of Minnesota. And I think that map is a little funny because it's on the southwest corner of our state. We had flooding not only last June in that part of our state, but also in our northeast part of the state, in a really geographic different area of the state. But we had flooding that affected both of those places. And so we had a federally declared disaster situation where you had responses that were very different in very different areas, but ultimately you had people who were in harm's way, who needed help and needed assistance being able to recover. So our work and my work at the agency has been really focused on trying to figure out how we can help incentivize Minnesotans to take steps before the next disaster happens to make sure that they can stay safely and healthily in their homes. And if we can, to help them save money in the process, because we know it'll be more expensive to recover from the next disaster than it will be to harden ourselves through it. So really excited for the conversation and happy to pass it on to Bridget.
Thanks, Peter. And I'm glad to go after these three gentlemen, because I think, particularly one comment that you made, Barney, about how do we avoid rebounding risk onto the taxpayers if that's what we choose to do. I think I spend a lot of my time thinking about what is an alternative path and what is the role of building these public-private partnerships so the insurance industry can help society transition to a more resilient future going forward. And so, one report that we recently came out with, which I outline on the next slide, is, traditional insurance can work well in a lot of scenarios, but given increasing frequency and severity of the billion-dollar disasters that Stephen pointed out across the country, and the massive gap that we have between total economic losses when disasters occur and the amount of that recovery that comes from the insurance industry, it's clear that we need some alternative options. And the series report calls for this. They call for innovation in support of innovative products. And I would say the insurance industry largely agrees with this and is well positioned to support a more resilient path forward. So here on this slide, I've outlined how we at Guy Carpenter, which is part of the Marsh McLennan Company, think about this holistic approach to risk management, which is really across the three pillars you see here on the right-hand side of the slide. First is taking an evidence-based approach to risk assessment and quantification. We have to first, understand risk and quantify it if we are to better manage it. Two is risk adaptation or investing in risk mitigation. We know this is critical for long-term resiliency and avoiding and stopping insurance companies from wanting to pull out of certain communities when the risk is too high. I've called out here on this slide that FEMA estimates for each dollar invested, it saves an average of $6 in averted disaster costs over time. So this is a really smart economic investment as well. And the third pillar is risk financing. So, right, we know we can't reduce the risk completely. So for what risk remains, we need financing mechanisms in place that can help societies, governments, communities handle the adverse events when they undoubtedly occur, in order so that we can reduce the strain on households, small businesses, governments, and ultimately the taxpayer, as Barney mentioned. On the next slide, I've mapped out a little bit on how the insurance industry thinks about tackling risk, quantifying risk. How do we bring best-in-class tools and resources to help our clients better understand their risk? Well, it's bringing to bear best-in-class catastrophe and climate models, helping clients really understand the vulnerability of their assets to these risks, to the wildfires, the hurricanes, the floods, and then what is the probability of various financial losses in a certain area in an average year that folks can anticipate, or in a really bad, unlucky year. So these tools and expertise that the insurance industry has in-house are really critical to helping society and communities chart a more resilient path forward. And that's why I'm excited about the public-private partnerships and helping, design solutions jointly going forward. And one of the innovative products that the series report called out was parametric insurance. And so on the next slide, I wanted to provide a quick snapshot of what that is, because I think it's, important for context and why it's a tool that we're seeing more and more communities and companies take up, because they're recognizing parametric insurance brings a lot of benefit as a complement to your traditional indemnity insurance. And so what parametric insurance is broadly differs from traditional because it triggers a payout based on the parameters of the event itself. So the trigger or the payout of the event will occur based on a specific wind speed or amount of flooding, or how bad a wildfire was in a specific area. And these products are, as I mentioned, a really helpful complement to traditional insurance because they have three key benefits that you see here in the blue buckets. First, they pay out really quickly because the payouts are based on third-party parameters and data that you've agreed upon upfront, and there's no need for a lengthy claims adjustment process. The payouts can be made sometimes in a matter of days, if not weeks. Second is they're maximized for transparency. So what quantifies a triggering of a payout is, again, agreed upon upfront using third-party data, often from government sources like NOAA or NASA. And so therefore, everybody has access to that, and they're highly transparent and good for the public sector in particular. And lastly, they're incredibly flexible. So payouts can be used for whatever clients deem necessary. That could be things like emergency repairs or business interruption. Local governments can use them to help fill tax revenue gaps or an increase in expenses that maybe they weren't prepared for. And this is really a good alternative to continued heavy reliance on debt or aid from federal government or alternative sources. So, unfortunately, we don't always see the holistic approach to risk management that I outlined in the beginning. But on the next slide, I just spent some time thinking, like, and this is, a conversation we have with states and communities across the country is how could you do a better job of bringing together mitigation and risk transfer to increase resilience? And so just here again, for example, a community could bring together these functions in what I've labeled here as a climate resilience center. But essentially the thinking is that you could bridge these two functions that are typically siloed. And this can help lead to, increased risk awareness, in more investments in mitigation. You can design these programs so that they actually incentivize more investments in risk mitigation. Can help lead to, over time, as that mitigation takes hold, reduced insurance rates over time, which we know is a rising concern across the country. Importantly, I think a faster recovery process post-disaster. Like, as I mentioned, these parametrics can pay out in a matter of days, and that's flexible dollars, so communities and individuals can get back on their feet much faster. And lastly, it protects the resilience budgets or tax revenues over time. And so, while I'm not aware of a lot of examples of governments or societies taking this holistic approach, I do think I wanted to call out the FAIR plans in some states, or these are the state insurance markets of last resort. Some of them are doing a really good job of offering their members grants for mitigation simultaneously with the insurance protection. And so I think that can be an interesting case study for folks to look at, or for a point of inspiration. So with that, I'm not sure. I hope I haven't gone over my time too much, but I'll hand over to Stephen for kicking off the conversation. Thank you.
Thank you, Bridget, and all the speakers for that great set of comments. Again, there's so much there we could cover. I'm going to have Diane, our colleague, just kind of walk through some of the questions. Diane, if you want to kick it off.
Yes, thanks, Stephen. Hi, everyone. My name is Diane May. I am the Senior Manager of Communications for the Series Accelerator. And yes, thanks to all of our speakers today. I'll start with a question from Molly, and she asks about incentivizing. She agrees with us incentivizing climate mitigation efforts and wants to know more about incentivizing climate adaptation.
Yeah, so I'm going to direct this to Jacqueline, but encourage other people to add too. Jacqueline, can you just talk a little bit about the Alabama program and Fortified and as an example in this area? But again, anyone else is welcome to jump in. Jacqueline?
Sure, absolutely. So obviously, climate mitigation and climate adaptation go hand in hand as we have these discussions. Alabama is an excellent example of proactive measures they took, home hardening programs. They've seen a lot of success reducing losses on the front end, and they're stabilizing the market on the back end. And this program they've built out, last I checked, I think it was 9 other states had adopted very similar mitigation and adaptation programs. But I'd also like to include things like nature-based solutions into that climate adaptation space. So it's not just the property level, but community level that mitigation and adaptation efforts, need to go hand in hand and move forward.
Great. Any of the other distinguished speakers want to add? Bridget, your hand's up.
Yeah, sure. Because I was on my last point there on the slide, I had the same examples in mind that Jacqueline mentioned on the FAIR plans, and just wanted to add one important point. And some of these FAIR plans in Alabama in particular, they're really doing a good job at incentivizing the climate adaptation and home hardening mechanisms, because they've equated that to I believe it's like a 20 to 40% discount on individuals' insurance policies. So that helps to just bring home that point of how can we bring together risk transfer and risk mitigation.
In Minnesota, established in 2023 legislative authority to build out our own version of the program that was established in Alabama. And this is a good example of states working together in partnership, and perhaps states that you might not think about working together regularly. But in Alabama, there's wind, and that wind is the same as there is in Minnesota. Our most expensive peril from a repair standpoint is hail. And so the fortified standards make a lot of sense in our state because, again, you provide health and safety outcomes to improvements for people who can hopefully stay in their homes after a storm, hopefully limit water intrusion into their homes, which can displace people for extended periods of time, to say nothing of the expense of trying to repair those homes. And you get, as Bridget was just describing, verifiable insurance risk reduction for the insurers, which helps them stay in the market and keep pricing hopefully affordable and accessible for the customers in your state. And we at the state get the benefit of all of that. And I think we really are thinking seriously about how do we use data to target or design an eligibility program that really prioritizes enhancing from an equity standpoint outcomes for Minnesotans who are most at risk because of either where they live or their economic circumstances, and also looking at the overlay of where we see our most expensive perils frequently happening or where they're projected to start happening more frequently. And if we can use that data together to design where we want to target really finite state dollars, hopefully that's something that we can bring to the fore in our state in the next couple of years. Great.
Thank you, Peter. Diane, back to you.
Yes, so our next question is from Sean, and they ask, on innovation, have you seen or do you anticipate seeing partnerships between banks and insurance companies? Lendability and insurability are very closely related, and there's obviously, a mutual interest between these two industries.
Yeah, I'm going to ask, turn over to Barney and Mike in just a second, but also to say is absolutely, as you think about the millions of people can't get insurance, they can't get a mortgage. In fact, 2 or 3 weeks ago, we did a project with the mortgage bankers highlighting this issue. But Barney, do you want to add anything? And then turn over to Mike if you want to add anything.
I think it's that's an area where you're going to need to see some important joint work. You occasionally see some partnerships. So in the sense that if you lose your mortgage, many banks have partnered with, a forced placed insurance company where they've said, if you can't find insurance yourself, we will go and have to obtain it on your behalf. But those tend to be reactive rather than proactive solutions. And part of this is complicated by the fact that the banks, obviously for a long time, have not kept those mortgages typically on their balance sheet. Certainly the larger banks, they're securitizing those mortgages and sending them out to other investors who aren't right now really thinking about the impact of climate risk on the value of those mortgages. But that's starting to change. You see climate analytics companies and investors who are thinking a little bit longer term about the embedded risk in these mortgages arising from climate. And I think that intersection between what insurance companies can offer and what banks need and what mortgage investors need is going to require more of a conversation amongst those parties that up until now have not really focused on this issue, which is of joint concern to the three of them.
Great.
I think Barney's right on that one. I think that for one is the fact that in this country there tends to be a very separate regulatory regimen for banks at the federal level, and the states have insurance at the state level. That's not a complication necessarily, but it does mean that it is not just a natural, like they're both in our house. There's a few insurance regulators that have state-based insurance, or excuse me, banking programs, but most have just insurance. And I think that's something that is difficult sometimes to really understand, that the insurance industry is looking very narrowly at its own bottom line, much less how it might be impacted from standpoint of getting loans from a financial institution, bank, and trying to make that work. I think that's really, really difficult. But I also want to throw in the fact that it's come up a couple times now about the FAIR plan as a backup for property casualty, particularly homeowners, to enable them to be able to have insurance coverage, which is something that is required, as Barney pointed out, by the mortgage lender. They're going to insist that they have insurance in place, and therefore they can't do the buy the home or build a house or whatever might be involved without insurance. But the idea of developing a public plan, I think it's much better to take the approach that Ceres is one of its recommendations, of seeing if there's in some way of being able to have some kind of coordination that takes place from the standpoint of the federal government or state government offering some kind of a reinsurance mechanism that can be a financial backup. But that's really a stopgap. The real challenge is changing the rules of the game for the original investment so that it is worthy of insurance coming in and lenders not being afraid.
Absolutely. No, it makes so much sense. I mean, it has to be priced the real risk. And we society have been underpricing it for a while. So that is a challenge. Diane, back to you.
Yeah, so speaking of risk, what are some of the most common gaps in the climate risk models currently employed by the insurance industry?
I'll turn this over to anyone who wants to jump in. Barney, you want to start?
Sure. So, I mentioned earlier that only after Hurricane Andrew and the Northridge earthquake and the advent of sort of more powerful computing capacity did insurance companies start to use these probabilistic models. And Bridget describes the components of those in her slides. The issue is that those models do two things. They look at history and they try to expand history and say, well, what could conceivably happen outside of what you have already seen? And they expand that over a very large portfolio of properties. That is not adjusted. There is no climate adjustment in those models. There's no forward-looking assumption or scenario that typically is embedded to say, what are your expectations for the next 5 or 10 or 30 years? They tend to focus on if the past looks like history, but expanded, what does that probability distribution look like for you? It's not that the science for that doesn't exist. Obviously a lot of people are working on that problem. It's that, the industry itself, and this includes buyers of insurance, this includes settlers of insurance, it includes brokers of insurance. Nobody particularly wants that additional lens to be added into the model. And this is where, some of the goals in the 10-point plan that Ceres laid out are in conflict. That's going to make insurance and reinsurance more expensive if you include a forecast of a more climate volatile future. And buyers of protection don't particularly want that. Sellers of protection don't particularly want that because often they can't price for that increased volatility. So it's not that the science doesn't exist, it's that the science that does exist has not been folded into the standard models for the industry. And there are people who are trying to change that. Obviously, regulators, shareholders, sophisticated property owners could all have a say in changing that. But right now, that is not a dial within the catastrophe models as they're generically used.
Great, that's very helpful. Diane, back to you, unless anyone else has any burning addition. Mike, did you want to add anything on that point? Okay, Diane?
Sure. We have a question about parametric insurance. Ken asks, parametric insurance seems to make sense for public entities, which can then self-insure above the limit / attachment point. How would parametric insurance be priced for residential or commercial properties?
Bridget,
And
oh,
specifically
sorry.
asking about something like fire risk.
So Bridget, do you want to kick that off? And then if anybody else wants to add on?
Sure, happy to. So you're correct in that parametric insurance would not work in every scenario. So it's often specifically for something like homeowners insurance. You could have it as a complement to your traditional insurance, but because it's meant to cover and trigger based on peak perils. So if you're, it's often designed based on for hurricane or flood or wildfire, and only pay out when those specific events that you're covered for occur, not all the other reasons you could have individual property losses. And so that's why it's often, it's not something that is sold as an individual replacement for homeowners insurance. It's thought of as a complement to help fill gaps where traditional insurance is not fulfilling. So it could be like a deductible buy down or covering, for exclusions that your traditional insurance policy has, or as additional limit on top, or as you mentioned, a good use for public entities where they have, a wide swath of expenses and gaps in revenue, losses in revenue that they weren't anticipating post-disaster.
Great, that's very helpful. Anybody want to add anything?
The only thing I would add is where parametric protection has been most useful. The questioner is correct, is either at a very high level of abstraction for a country or for a state to say, I just need an injection of capital directly after an event. And you've seen, particularly in emerging markets, the Philippines, Mexico, African countries say, I can't borrow money after an event. I need an injection of capital after an event, and I can then figure out, as Bridget described earlier, how best to parcel out those funds to make sure that my country is fine, or where existing insurance isn't available. And that could be a hotel on Miami Beach that just says if the wind blows more than 120 miles an hour, I know that I'm going to suffer damage and I can't get enough protection for my hotel. Or it could be for a farmer in, Colombia, where they don't have a local insurance policy, but they know if it doesn't rain, they're not going to have a coffee crop. And that's also where it's been successfully used. So it's really either augmenting at a high level or substituting in a place where you just don't have the ability to have a conventional insurance product and claims.
Very helpful. Oh, Mike, sorry, do you want to add something quickly?
I would just say that augmenting at the higher level is really the most important feature right now. It's not going to be down to the individual homeowner and the house they want to build on a piece of property. It's going to be much more of a whole geographic area. It's going to be a city, a state that's going to wind up making the investment into parametric insurance because for the very reasons here, so they could wind up having some capital that they can work with immediately after a catastrophe occurs. But it's not going to, for the individual homeowner, it's less of an issue. It can be a major incentive, obviously, if it's done correctly and balanced with regular insurance, how they might approach a particular geographic area. But it's not going to be down to the individual homeowners. I think there's often a feeling here that there's a silver bullet out there, and this is not one of them.
Excellent point. Diane, one final question I think we have time for.
Yes. So Jordan asks, are there policy tools that could be utilized to nudge insurers toward more widespread adoption of term structures of multiple years?
Let me turn that to Peter if you want to start, and if you want to pass, feel free to do that.
I think I would probably pass. I mean, I think from a regulatory perspective, it's hard to suggest to companies that they sell a specific thing or a specific way. And because we have different regulatory regimes across the country for how P&C products come to market, I think regulators have historically been in a reactive mode to new product innovations like that. I'm not saying that is something that's good or that should stay that way, but I think it's a challenging question probably for me to answer, Commissioner Kreidler to have answer. So I don't know, Barney or Bridget, if you have thoughts on that one.
I would just say that this is something that as long as I was an insurance commissioner, we were wrestling with, is to see how we could somehow develop some kind of longevity from the standpoint of an insurance product. The last thing you wanted to do is to see an insurance company losing money over the first couple of years because it was very expensive, and then after that somebody else comes in and says, I can give you a better price, but they didn't they weren't there when the risk was by far the greater, and I think that's been the tough part for insurance companies, and it's been tough for regulators and they have not been really presented with a really comprehensive idea of how you could meld that together in such a way as to see the risk being something that you could make sure that the company could look at return over time, and not necessarily over a brief period of time. Let's say 1 year is much too short, and much more likely if you can get it to 5 or 10 years where you have that kind of spread out, and then the return on investment becomes much more significant and realistic then for the insurer.
Yeah. Oh, sorry, Peter, go ahead.
I was just going to add too, I think parametric insurance is another example where the regulatory agencies have struggled candidly to figure out how to integrate that into the existing regulatory regime. Now, I think the states, and particularly states like Hawaii, have really been at the forefront of helping us across the country figure out how to do that. I think the work at the NEIC has really helped drive a lot of that. So we're moving in those directions, but it is something that, particularly for a state insurance department that's mid-sized like ours, it's hard to find the intellectual time to be able to think about new product innovations and help bring them forward, and then think about how you would move them through a regulatory process that was built many decades ago for something different.
Yeah, I mean, the one thing I would add to that is just following up on that last point that Peter made, the insurance industry as it was designed assumed that the climate was stable generically, which it was for a long time, and assumed that you would have plenty of capacity available to you as a consumer, many choices of insurance. And so therefore, the regulatory regime was all about keeping policyholders safe. Well, all of those things are not true anymore, right? So the climate is not stable. Policyholders can't get coverage. And so, the counter argument to Mike and Peter's points are, it may be time from a regulatory standpoint to not stand in the way of developments, to say, okay, parametric coverage, even though it is not a product of indemnity, is a product of risk transfer. And in the interest of getting more people covered, we want to allow this to be counted as insurance. Or if somebody has a 5 or 10 year mortgage and wants to know that they can get an insurance policy for 5 or 10 years, not to veto that or to stand in the way or to keep people from being able to buy something more than 1 year, but to say, in the interest of actually having a market, which is, insurance is increasingly experiencing market failure, allowing more new product features. So, I certainly, you gentlemen have served in that role, which I never have. I certainly understand the difficulty of proactively saying, here's what the answer is. But people approaching regulators and saying, can we do this to try to solve this problem? Saying yes rather than defaulting back to, the standard, which was based on an outdated set of assumptions, seems like that could be a positive path to pursue.
Well, clearly, these are complicated issues that we hopefully this webinar has helped to stimulate that conversation. I'm going to go back to each of our speakers and literally give them 20 seconds, 2 sentences. If there's one point you want to highlight, something you've either said or not said, just if it was one thing you want people to remember. So Bridget, I'm going to go in reverse order from before. Bridget to you, then Peter, then Mike, then Barney and Jacqueline. Again, 1 or 2 sentences.
Okay, pressure on. I think I know to one of the points I wanted to make in that last good conversation that was going on there is that you would agree new times call for new measures and new solutions. And so things like parametric insurance or a framework that my company put out forward together with the Wharton Risk Center a few years ago called community-based catastrophe insurance aims to help fill those gaps. Well, we have to step back and realize we have a huge problem here. Less than 5% of Americans actually have flood insurance. Very few have earthquake insurance, even when they're posed. And, as we saw in California and Hurricane Helene, there are these massive gaps out there where, people are not able to fully rely on insurance the way they had been in the past because
Bridget,
the current environment isn't working. So
sorry, I apologize. Thank you. Those are great points. Peter, in literally 2 or 3 sentences.
We're all impacted by natural disasters across the country. Ideas for partnership and mitigating those natural disasters can come from across the country as well. We have to be innovative if we're going to stay competitive, and we're going to have financially stable insurance markets that our neighbors can access.
Great. Barney.
I think we face a fundamental choice as to whether insurance is going to just become a government product provided to citizens, not provide a price signal, not provide useful information, or whether we're going to have a true vibrant market for insurance, which means letting insurance be a market, which today it's not.
Great. Mike.
I think insurance companies need to be really cognizant of the fact that they cannot be in the game today and then out tomorrow, depending on how the environment responds. They've got to be in it for the long term, and it's going to be one that it's going to require some rethinking on their part and some heightened coordination and cooperation in the insurance industry to allow that to happen. And they need to make sure that they have the regulators on board to make sure the enforcement works equitably and fairly for all.
Right. In the interest of time, Jack, I'm going to skip you. Sorry. So let's put up the final slides with deep thanks to this distinguished group. We'll also send this out to you. We'd love feedback on anything we said today. Obviously, we touched on a bunch of issues. We didn't solve anything, but we want to go deeper. Next slide, please. So we also working in many states on freedom to invest, allowing insurers to operate their business. We'd love to talk more about that. We have a series of reports on insurance and many other topics. They're all public and free. Next slide, please. We have a bunch of events. Please take a look at that if you're interested. Next slide. We have next week, actually, we're bringing many people to Washington to talk about these issues on Capitol Hill. And if you're interested, let us know. And if you want to subscribe. So with that, thank you for everything. Thank you for your time. You'll get this. Special thanks to the speakers. There was a high bar and you beat that bar. Have a great day, everybody. Thanks so much.